Good afternoon, everyone. Thank you for joining us today. My name is Aron Betru. I'm the Managing Director for the Milken Institute Center for Financial Markets. You're joining us for what I hope to be a good discussion on investing with impact in underserved small businesses. I'd have to say this is probably the most important topic you're going to find at the global conference. Mike Milken believes that investing in small business, access to capital, it is one of the things that's most near and dear to his heart. He often recounts the story of when he was a graduate student driving around after the Watts riots here in LA. He was trying to understand these disadvantaged communities, what really was required to revitalize them. It actually became kind of the cornerstone of an equation that he came up with later in grad school, his prosperity equation. How many of you have heard of that prosperity equation? Show of hands. Okay,
Just
all
heard
of you.
it the first time over lunch.
Okay, perfect. So it is a key part of how the Institute drives our understanding of shared prosperity and making sure that communities have an opportunity at building meaningful lives. And I would say small businesses is at the cornerstone of that. Now, when we talk about the theme for this conference as navigating a world in transition, I think it's important to contextualize a little bit what the transition we're talking about. Can I get the first slide on? There was a piece of research that was done by the National Community Investment Fund that actually showed over a 30-year time period, there was a drop in median household wealth from 1983 to 2013. You saw about a 75% drop in median wealth in the African American community and about a 50% drop in the Hispanic American community. What they identified that effectively would take 200 years for African American households to reach non-minority households. It would take about 80 years for Hispanic households to reach non-minority households. So this is the background context of the transition that's been happening throughout America. So when we look at small businesses in particular, they are a key driver both in terms of wealth creation, in terms of job creation, not just in the US but around the world. And we're joined on the stage with a group of luminaries that have actually had this subject matter as a core thing they've been focusing on for many years. And so what I'm going to ask all of us to do is just take 30 seconds, share your name, your organization, and how you've been engaged in increasing access to capital for small business. Just 30 seconds. We start with you, Maria.
Great. Hello. How's everybody doing? Good, good, good. Well, I'm Maria Contreras-Sweet, and I began to engage in the notion of access to capital when then Governor Gray Davis asked me to serve as California's Secretary of Transportation. And therein lied the challenge that we were trying to create local jobs, California jobs at the time. And California is the most diverse state in the union, as we know. And so trying to get more women and Hispanics, Latinos, Asians, Native Americans to engage in the work that we were building. We're putting out billions of dollars of capital projects, and women weren't applying. And so I learned the challenge that they said, you take too long to pay, and I can't get a loan to be able to finance the float. And so, I left after I left that organization, working for you in that capacity. I started a bank here in Los Angeles, and then realized again the challenge, because even as a small woman-owned institution, I found that it was hard to get deposits and to get the larger institutions to invest. And so I understood then better the challenge of the pipeline. So fortunately, the president, they called President Obama and asked me to serve as your leader of the United States Small Business Administration, wherein I think that we were really gaining some momentum. We were able to increase loans to women, for example, by 23%, and to African Americans, since the number was so low, by 70%. We increased the numbers, and so that
You're stealing your own thunder, by the way.
Yeah, I know. I'm waiting for the big applause here. It's not happening. Not happening. But truly, it's been a challenge, because what we see is that, as you all know, that access to capital is being difficult. When you have the concentration of capital in 25 zip codes, and you have women getting anywhere from 46% of that capital, and African Americans and Latinos only 1%, that we know we have a challenge. So I continue to work on that. And just by way of introduction, I think that's what Aron is, what's being hinted at here is the reason I'm so personally committed to it is because I got here as an immigrant. I was born in Guadalajara, Jalisco, Mexico. And when I got here at the age of 5 and couldn't speak a word of English, I just remember my grandmother being a migrant worker, and she said, but if you study hard in America, Mija, my daughter, she said, someday I believe that you'll be able to work in an office and be a secretary. So, of course, I had the pleasure of praying and thanking the good Lord for hearing my grandmother's sage words and for allowing me to serve in office and to be a cabinet secretary. That's the prosperity that America can continue to provide, but it won't be if we're just on default mode. We have to be actively engaged in the process and have an intentional commitment.
Thank you. Thank you. John?
That was great. It's tough to follow, honestly. So I'm John Lettieri. I'm the co-founder and president of the Economic Innovation Group. We're a research and policy organization based in Washington, D.C. We've been working on this issue for the last 5 years through the form of the Opportunity Zones program, what is now known as Opportunity Zones. This is a concept, a tax concept that we designed and helped to push through in the tax reform bill, aimed at getting equity investment, unlocking equity investment for low-income communities around the country. So this is an innovative new concept. We're in stage 1 of the process, and so I'm looking forward to talking more about this today.
Perfect.
I'm Annie Donovan. I'm the director of the Community Development Financial Institutions Fund, or CDFI fund. We're part of the U.S. Department of Treasury, and I've had the great fortune of having an almost 30-year career in community development and community development finance. And I got my start actually as a Peace Corps volunteer. And I was serving in Jamaica in 1988, and one of the biggest hurricanes that's ever hit that island hit. And people from home were saying, what can we do? So I said, send money. And we started a revolving loan fund and lent money to the fishermen and the village shopkeepers to recover after a devastating storm. And that's my origin story, and I've been at it ever since.
Well, that's a wonderful story to share, and I'll tell you another one. This is her birthday, so I want to make sure that everybody wishes her a happy birthday.
Oh, thank you. I'm Kimberlee Cornett. I oversee the social investment work at the Kresge Foundation. Kresge is a national foundation based in Detroit. We use debt, equity, and loan guarantees to create opportunity for people with low incomes living in America's cities. And small business investment is integral, obviously, to that broader mission, but we've made a number of investments, both through CDFIs as well as through development finance agencies to create those kind of opportunities.
My name is Kim Saunders. I first want to thank you for this opportunity to participate on this panel and for this session. I am President and CEO of the EADS Group. Our mission and purpose is to help minority banks and CDFI banks survive and thrive. I'm also a senior advisor with the Milken Institute Center for Financial Markets. And I guess I started this journey really from boarding school and really having a chance to see the benefits of wealth in the country. The boarding school was started in the 1800s. I was the 7th African American graduate. And my life mission and purpose is really to try to help get rid of, I heard the World Bank mission, and it's really mine, to help end poverty and increase shared prosperity. So that's my goal.
Thank you. That sums it up well. I'm going to start with you, Maria, a little bit. So we shared the stats in terms of what's been going on in terms of household median wealth. You were at a very important organization leading as the administrator for the U.S. Small Business Administration that is meant to empower small businesses. I'd love for you to kind of underline for us how important is the small business segment for the American dream?
Well, I think, you know, I've always lamented that when I went into any community, in any role that I've had in the past, if you talk to a municipal head, the mayor, the city manager, they always said, you know, oh my gosh, if you can help us land a corporation. But when a small business showed up at that city, it was stand in line, go pick ticket number 3, number 4, and yet we know, right, that 3 out of the majority of our jobs come from the small business community, and a small business can transform communities, as we've seen. I remember when the SBA helped to seed years ago, long before my time, I take no credit, Qualcomm. I ran into a gentleman, and the founder of Qualcomm explained to me how SBA changed his life. He was a small entrepreneur. We gave him some access to capital. Now Qualcomm is one of the largest companies in the world. I was at a recent event, and not so recent now, it's been a few years, but a handsome young gentleman came up to me, Kevin, and he told me that he couldn't access capital, and then one day he went into a bank and they said, you ought to go look up an SBA loan. And they said, what's your concept? And he said, I want to put technology into fabric, into clothing. And they said, God, this guy's nuts. Like, yeah, maybe you definitely need an SBA guaranteed loan. And he went and he sought it and got it, and now he's growing a company called Under Armour. And so those are the stories that we replicate over and over and over. I love traveling the country and meeting small business after small business, Chobani's, I could go on, Ben & Jerry's, all the companies that just for somebody triggered an SBA loan and made a difference in their life, and they transformed communities. And so I would urge anybody in municipality and governance to think hard about the role of small businesses. They are transforming companies, I can tell you, just the role that they play across the country. And more important than that to me, I heard what Einstein said about the most powerful force, but Barack Obama and I agreed on one thing, and that is that we think entrepreneurship is the most powerful force. If you can't get a job, you can create your own, you can start your own job. But we, we need to make certain that we have an open mind when we go into a bank, and that's why I started a bank. I think it's fundamentally critical for us to be able to access capital. Without capital, you don't have the fuel to grow your idea. And so, so it's incumbent upon us to have organizations like the CDFI to help us get there. And to you, Kim, for helping minority institutions who are fueling that sector continue to grow and prosper. We don't have community banks that are viable. It's very, very difficult. So your role is crucial. Thank you.
I mean, she raised your name, Kim, and I wanted to share a statistic. A few years ago, there was a White House convening that shared at that time the U.S. economy had been experiencing 65 months of consecutive job growth, principally being driven by the small business sector. But over that exact same time period, SBA-backed lending to the African-American-owned small business segment had been declining 91%. There was a whole suite of both structural issues and other issues. But essentially, this is not easy to do. And Kim, you used to lead 3 different institutions that were serving the disadvantaged small business community. I'd love for you to share your thoughts on how we can overcome some of those challenges, and what were some of the challenges that you experienced?
So just to echo, it is challenging to serve those particular market segments. I'll just share, though, I think that MDIs and CDFIs, I've been in that business for 20 plus years, serve a unique role. And just to give you a couple of practical examples, I taught a class on small business financing at a CDC. A class participant showed up at the bank. He was a professional who wanted to start his own business. We literally worked with him for months to get his package together. He ultimately got an SBA guaranteed loan and was able to open up several retail locations, obviously create jobs in our community, went on to actually become a featured story on Oprah. So that's just one story. We had another case where we had a housing developer who wanted to do some work in a specific very poor neighborhood and block. He had a prior bankruptcy. He had a 400 credit score. So this is very tough work. How do you actually do that type of banking well in a safe and sound manner? But it's specialized work that minority banks have been doing for centuries. We know how to work with those customers. We take the time to get to know them. We create trusting, caring relationships, because you have to get behind that score and understand what they're trying to accomplish. And then we literally will roll up our sleeves and work with them to put their packages together to create an appropriate credit structure. I always say, I have to sleep as a lender and you have to sleep. So it has to be a workable transaction. That gentleman went on to develop blocks and to help turn around a neighborhood. So MDIs and CDFIs are on the ground with specialized forces doing the work. We know those customers deeply and serve a unique and very important role in providing access to capital to small businesses.
Thank you for sharing those points. I mean, it's probably not lost on the audience that in a lot of the neighborhoods when we talk about underserved markets, we're also talking about the vast majority of the communities after 2008, where there was quite a big retraction of the commercial banking sector, or essentially the community banking sector, that created quite a few banking deserts and created quite a bit of a gap. Now, Kimberlee, within the Kresge Foundation, you guys have been trying to step up and provide a little bit of support to bridge that gap. It would be great to hear how a philanthropic organization like Kresge is engaged, especially in on-the-ground transactions in Detroit, which is one of the hardest hit areas across this nation.
Although lots of good stories coming out of Detroit these days, thanks to a whole range of social investors who really weren't afraid to come into a distressed area, really, when there didn't look like there was any hope of recovery. And I'd encourage you all to learn the story, because it was a terrific example of what philanthropy, CDFIs, development finance agencies, and the public sector can do together when we really set that table to problem solve. Kresge began a journey to use other forms of capital to achieve our objectives about 7 years ago, recognizing that grants were simply not going to be enough at the scale of the problems that we were facing, and we saw that with the math earlier today around the Sustainable Development Goals. And so we began developing both the capital and the staff capacity to use investment. Jennifer Price from the Calvert, newly named Calvert Social Investment, I believe, actually put out a piece
Calvert
today.
Impact Capital.
Thank you,
which
Calvert
I must
Impact
put as a
Capital.
disclaimer I'm on the board for.
Thank you for correcting me. But Jennifer put out a piece today that I thought was really interesting, and it really talks about the life cycle of many different kinds of opportunities, moving from grants to philanthropic investment, and on a journey to the capital markets. And she really spells out the life cycle. In part, she calls some of those unique opportunities misfits, I'm sure in a very loving way. And our job is really to help some of those misfits along that journey towards a place where they can be financed in the capital markets. Recently, we convened a group of 25 lenders and investors focused specifically on small business as part of an effort that we're engaged in around what could potentially be the first ever multi-investor domestic guarantee facility. So this is a facility that may be parallel to some of the guarantees that come out of USAID for other parts of the world. And what we're really trying to do here is to try to figure out where are those capital gaps that through guarantees we can help accelerate the sources of capital going into a community. And what we heard from those lenders, again, specifically focused on small business, was a lack of track record for those businesses, sporadic cash flows, and a lack of collateral or low FICO scores for the business owners. And so what we're trying to do is figure out if we can create a facility that will really activate what is very much an underutilized tool on behalf of foundations and social investors, and that's guarantees. And our CIO, Rob Manila, put out a piece today around essentially the capital efficiency of using guarantees for foundations. And I'd encourage all of you to look at Mission, Money, and Markets on the Kresge website to learn more about his perspective as a CIO. So we're trying to do three things. We're trying to activate an underutilized tool. We're trying to make that tool very efficient for both the guarantors and the beneficiaries, and we're trying to materially accelerate the amount of capital that's available in three sectors: small business, housing, and climate.
Thank you for sharing that. Annie, before I come to you, I want to actually share with the audience the last slide. When we look at essentially all the different institutions that are serving communities, there was this interesting study that was done by the NCIF in partnership with the Office of the Comptroller of the Currency, the OCC. And they tried to put this 2x2 together, which actually on the x-axis, what development deposit intensity means, the proportion of a financial institution's footprint in low, moderate income neighborhoods. And the y-axis, development lending intensity, is the proportion of their lending that goes to individuals in those communities. And the 2x2 basically shows CDFIs and MDIs are in that top left coveted box of not only are they present, but they are working in those communities. And then when you look at the top 10 banks and all banks, they are not. And so when we talk about what's the best way to mobilize capital, CDFIs and MDIs are really powerful entities. And Annie, you from your seat at the Treasury as heading the CDFI fund, you have an unbelievable viewpoint of using public resources, federal resources to galvanize this group. So can you
Yes.
share with us a little bit there?
Sure. Well, let me start just by saying that if you haven't heard of a CDFI before walking into this room, I'm going to make you feel a little bit better for a second, because what you saw on that graph was really telling, and it proves the point that CDFIs and MDIs, and many MDIs are CDFIs, punch above their weight in terms of the impact that they have in communities. But if you look at the assets under management by CDFIs across the United States, they round up to about 1% of banks and credit unions. And so, sometimes when people say to me, well, I never heard of a CDFI. Well, we do as much as we can to put the message out there, and we are very well known in some places, but we're not a general household name just yet, because we still are, the CDFI sector still is a small portion of financial services. But the CDFI fund has been around since 1994, and we certify community development entities, and they come in many shapes, sizes, and forms. And we are pretty much agnostic, whether some are for-profit, the MDIs are all for-profits, other kinds of community banks, of which there still is a network of community banks out there, and they're doing really great work in banking communities that are underserved in many, many other areas. A lot of times these small community banks are the only thing in town that are sort of holding the economics of the place together. So some CDFI banks, some CDFIs are banks, some are credit unions. About half are loan funds, and they are mostly nonprofit, although some are for-profit, unregulated financial institutions. So with all these different types of institutions, what holds them together? And the thing that holds them together is they have to have a primary mission of serving underserved communities, and 60% of their assets have to be invested in target markets. So your target market can be a geography, it could be a group of people who suffer from a lack of access to capital. And so, the stats you gave on minority-owned businesses and their access to capital, there's clear case there for targeting CDFI resources toward that community. So CDFIs have collectively about $150 roughly billion in assets under management. And I think what's so powerful about the CDFI fund is that we support this network of community-based lenders and investors with enterprise-level capital. So a lot of times when government invests in something, they're guaranteeing a particular business, or they are investing in a project. In the CDFI fund, we invest in the capacity of organizations. And so the beauty of that is that there's this national network out there that exists in all 50 states, all of the territories, and they're still small, but they are mighty, and they are on a trajectory to get bigger. And there is just a lot of activity in those CDFIs, and some of it is small business. There's also other things like affordable housing, transit-oriented development, childcare, education, healthcare, lots of different types of financing that's happening around comprehensive community development strategies. So, that's
it's important to contextualize, though, that in this segment, when we looked at that chart, the CDFIs are, for the lack of a better word, they're subsidized. And serving this space is not easy for all the things that Kim shared. Effectively, post-2008, the regulations that were brought on financial institutions did make it harder to serve this space. And it is worthwhile.
Can I react to that? Because in your Milken instructions, they say, oh, we like robust.
Please do.
So I'm going to get robust here. Well, I don't like the word subsidized. And the reason is because what we see, what we're doing is investing in organizations that then leverage it. And I think that that if we're going to use the word subsidy, we should put smart in front of it, because what we're trying to do is really get the capital markets. I mean, we're all trying to get along the people mainstreamed, right, into access to capital like everybody else has access to capital. And so this is just a shot in the arm along the way to get you there. And it's really it's meant to counter that, the way our financial markets work is that capital goes to the place where it gets the highest return for the lowest risk. And, that formula breaks down in some places. Sometimes it breaks down because there's a perceived risk and there's not really a risk there. And CDFIs, in my early days in a CDFI, I was like, don't tell anybody, these aren't really that risky, because we're doing these loans all day. So some of it is that, but it's really, we're trying to just fill that gap so that the market actually works in the communities that are being targeted.
I'm a huge fan of smart subsidies, all the way. But the point that you're bringing out is the engagement that we should have with the different stakeholders should be fixing the right set of incentives to get private capital
Exactly.
in. And I think, John, I'm going to come to you in a second, because the administration has taken a leap forward right now with trying to get a massive fix of incentives to get private capital to move into low and moderate income communities with the last round of the tax reform. I'd love for you to share these new developments for those.
Sure. Let me take a step back and talk about the scale of the challenge that we're talking about here. A lot of this is, in the post-Great Recession economy, it breaks down by place in a way that we haven't seen before. So those national numbers that we look at, this record long or nearing record long economic expansion, the unemployment rate changes, the GDP growth, those national numbers really obscure a much more fractured local picture for tens of millions of Americans who have lived in communities. And in our research, we show for the bottom quintile, the bottom 20%, that as of 2016, they had seen, as a cohort, 0 increase in jobs or businesses over the period of that recovery. And that's just an astonishing figure. On average, the average zip code in that bottom quintile has lost more than 6% of its local businesses and more than 6% of its local jobs. So a lot of that growth is concentrating and reorienting in a relatively small number of places, really a record small number of places. So the scale of the challenge is getting bigger, and our toolkit from a public policy standpoint is just sorely out of date. It's not oriented towards understanding or recognizing that we need a response mechanism to correct market failures that exist by place as well as in other types of sectors. And so to meet that challenge, we have now a really ambitious and innovative approach that's been taken in the tax reform bill. Started as standalone legislation called the Investing in Opportunity Act. And the concept here was really aimed at taking advantage of one growth area of the economy, and that's unrealized capital gains that investors hold. Today, our estimate, looking at Federal Reserve data, as of the end of 2017, it's over $6 trillion. That's a record amount. Stock market gains, corporate profitability. So the parts of the economy that are humming along and working well, and the investors who are reaping the benefit of those investments, are sitting on a huge pool of unproductive capital, in the sense that that's not money that's going into underserved communities by and large. It's very hard to trace a dollar in capital gains in the equities market, for instance, and to see that it has any chance of going into a productive business in a low-income community. And so the hack here is, how do you connect those dots? How do you create a community finance pool of capital in the unrealized capital gain space and give investors an incentive to roll that over into productive investments? And that's what's been done. So it's called Opportunity Zones. This is a concept that now will apply to every state in the country. Governors have just finished and will soon, I think, have fully certified by Treasury the places, the low-income communities in each state that will qualify for this incentive. And it sets a playing field, a new map for ways to connect investors with communities that they've traditionally overlooked, and to make that something they can do at scale. So rather than hoping that an individual investor is going to be a first mover in a tough area, that you can get them to move as a herd and use the force of that herd really to the advantage of low-income areas, rather than having that continue to work against them.
Can you explain a little bit how the opportunity zones were selected, but also walk us through kind of a typical way of how an investor might actually engage?
Sure. The statutory criteria set the same baseline that New Markets Tax Credit uses. So the governors start with the low-income community census tracts. Roughly 40% of the country falls into that category, so it's a big swath. And the goal for the governors was to down select, to find the places that were the right match, both in terms of need and opportunity for this type of incentive. So they led the process of saying which among the low-income tracts in their states, and they could choose up to 25%. So if I have 100 low-income tracts in my state as a governor, I can choose 25 to create the opportunity zones. And the mechanism is, if I, as an investor, have capital gains, I can roll those over on a tax-deferred basis into special category of funds called opportunity funds, which will be private sector entities created to respond to market interest, and that can be used to deploy capital in a whole variety of different areas. So everything from affordable housing to business investment to green energy to you name it. There's a wide swath. And so that flexibility, both in terms of the types of places being led by state and local leaders, and in terms of the financial innovation in the marketplace, means that you have a very flexible incentive that's scalable nationally. There's no cap on this because we're asking investors to use their capital, not giving them an upfront smart subsidy. And so both approaches are important, but in this case, what it allows you to do is to get to a non-allocated amount. So if I have a fixed amount I can allocate every year, it means you have a fixed number of communities that are going to see any kind of benefit from this. In this case, without that fixed allocation, the more that investors are interested, the higher the scale of this nationally, and the more communities that can benefit simultaneously. And what's important is in communities, multiple different investments can be happening within these zones that create an ecosystem effect that you simply can't get with one project here and one project there. And so this is a great complement to existing programs like LIHTC or the New Markets Tax Credit, SBA loans and financing that, if worked in coordination, can provide a huge boost, particularly in the equity capital gap that so many of these communities face.
No, thank you for sharing that. I mean, in all honesty, this could very well be one of the largest flow of capital coming into low and moderate income communities if it's done the right way. And we have, fortunately, on the stage, 2 former bankers that have been serving these communities. I'd love to hear any thoughts that you have as individuals that have served these communities. Maria, why don't we start with you and come back to you?
Thank you. I'm really enthusiastic about this program. I've just read just a little bit about it, but was really piqued by its potential. And so I congratulate whoever came up with this concept and hope that it will be executed successfully. But I must say that setting that aside for a moment, I was equally disappointed to hear that there may be a softening of the CRA rules. And so I think we have to, make sure that we're not taking a step forward and then 2 steps backwards. And so I'm just concerned about the entire pipeline of access to capital. For example, one of the things that I was dedicated to, and I was just so disappointed that it was dismantled, was this notion of that America believes in a second chance. We believe that if somebody has gone left when they should have gone right in their life, America gives stars, celebrities, white-collar criminals a second chance. And I thought, why shouldn't the people on the street in the front lines be given a second chance? Somebody took a drug maybe when they shouldn't and they got caught. They find themselves as felons when they come out. They've paid their dues to society. Why aren't we helping that sector of the population begin with a micro loan? And so I joined what we call Ban the Box movement to say, why are we always asked to check the box if we've been a felon? To what end? Because you're going to be turned down at the very end of that. And so we said, let's ban the boxes. Somebody's paid their dues to society and they're doing well and they've lived well for a couple of years. We're prepared to give them an SBA loan to help them spur their first step into entrepreneurship with a small loan. And and it was taking off and it was beginning to do well, and foundations had reached out and said they wanted to lever that program. So I see that so many programs were dismantled that I thought were taking off, that were doing really well. The CRA thing really concerns me because I think financial institutions, particularly the large ones, have an important role in our communities, and I hope that doesn't dissipate. I have found, and I think that you've all seen, just stepping back for 2 steps for a little bit, that television doesn't reflect America, it shapes America. I believe that when we walk into banks, when we walk into places, whether we're women or whatever, there is kind of a bias. And so I was just trying to take biases out of the equation. And so another program that we put up is where you apply online, and then people would look at your profile just based in writing. You don't know if Terry's a guy or a gal, And we found that there was a higher preponderance of lending under technological innovations that we had put in place. So I wanted, I'm hoping that all of those programs that we put in place will continue to grow. Somebody will bring them back and make sure that they prosper. For my part, because I do believe that, I think any of us could tell. I just had an experience just a couple of days ago where I answered my front door and somebody asked me for the lady of the house, And I said, I am the lady of the house. And so, but I had my pigtail up on top of my head and I was in my slippers and I could imagine what they thought. And so there's always a bias, right? Every one of us has a story where we went somewhere and we were turned down and, then my waspy husband walked in and they said yes to him. I mean, I have so many stories like that, it's pathetic. And so I think it's so important that we also improve our view of life and society and embrace each other. And so of late, I think that you all heard that recently I was engaged in trying to buy the Harvey Weinstein Company.
Maybe a little bit.
Just a little bit. Wall Street Journal was really interested because I wanted women to take hold of a major Hollywood industry and begin to tell our stories so that society wouldn't have these institutional barriers towards women and to minorities. So I continue to challenge all of us, whether in the private and the public sector, to continue to come up with innovative ways in which we can continue to break glass ceilings.
Thank you for sharing that. Essentially, learning from past policy learnings, learning that there is bias in the space, both structural and historical, and taking that forward, it matters to making sure that this piece of legislation actually delivers exactly what it's intended to do, which is to lift low and moderate income communities. Kim?
So I'm very excited about the Opportunity Zones funds and their formation. I think for the first time, it's an equity-driven opportunity, and when I think about the challenges that small businesses face, as Kimberlee mentioned, a lot of times it's lack of that equity component or adequate collateral. And so I see a tremendous opportunity to create the kind of ecosystem that was referred to earlier. My hope is that it does not become a real estate-driven program. I think we have enough of those, and that it really does focus on small business creation and the support of small businesses within those census tracts, because then we really have an opportunity to create jobs and to change people's lives in a holistic sort of way. And even if you have real estate, you need prosperous tenants in order to create value, and you need thriving communities in order to create value. So I'm excited about it as much as I was the CDFI fund when it was created. And I again think it has a tremendous opportunity to be transformative in a quick, powerful way if it's guided and directed properly, and leverages, again, the minority banks and CDFI banks that are already on the ground doing so much of the work.
Thank you for sharing that. You reminded me of a key point on this, on the equity piece that John brought up. So the Milken Institute actually runs a program called the Partnership for Lending in Underserved Markets, which is an effort between the Milken Institute and the Small Business Administration to really figure out both the root cause problems, but also try to identify actionable solutions. And one of the things that was hammered constantly was the lack of equity capital, and that's a key piece that John shared. And by the way, we should absolutely be thanking John and his co-founder, Stephen Klickman, who lead the Economic Innovation Group, which were definitely behind both the conception and driving this forward. So thank you for this leadership that you've shown in that effort. And I want to say within the Plum program, we've come out with some really interesting findings that include this point on equity, and if anyone's really interested in that, there are outputs from the second phase of this work that are in the back, so feel free to have that. So I want to say we probably have about 15 minutes left in the session. I think it's important to actually engage with the audience on this, and so I'd like to take a few minutes and ask if there are any questions that you would ask of anyone in the on the stage. Please do. Why don't we take about 3, and then we'll cycle back, please.
Opportunity zones. How do the people who have these unused, uninvested capital gains find the projects to invest in?
Okay,
So
that's one. Why don't we take 2 more, and then we'll come back to it.
Sure.
How are the small business owners supported in terms of learning how to be good small business owners, given the failure rates for everybody of any background failing at a small business, it's pretty daunting.
Small business success.
One of the stipulations of the Community Reinvestment Act was that they wanted to keep the branch networks in the low and moderate income areas. And do you think that that's really important, and what impact do you think that that has?
Assessment areas. Okay. Why don't we just take the fourth one right there?
Mine's not a question. I had a conversation with one of the panelists, and I wanted to know whether she wanted to share it, about 41 years ago, the Community Reinvestment Act was passed, and its intent has been very different than some of its outcomes, and whether what policy arguments can we make for strengthening what the Community Reinvestment Act was intended to accomplish?
So 2 versions of CRA that we can talk through, and a very important question on small business success rates and the need for technical assistance, the absorptive capacity, and a deeper one on the opportunity zones. Why don't we start with the opportunity zones, and then we'll see who wants to take CRA and small business success.
Sure. Well, I think the question was, how do we find deal flow, the investors and the communities? So that's a big open question at this point. At a practical level, it's going to be, and I see some of the intellectual firepower in the room right now that's going to help answer this question. It's going to be states and cities making transparent information locally on what the opportunities are they're trying to promote, what type of projects are in play, what type of businesses qualify, and making that visible to investors, not just locally, but nationwide, because this is, you can be from anywhere and invest in any zone nationwide. I would hope that there'd also be a robust federal effort to make sure that that data is transparent, and that the more we can collect at both the local and the national level, the more we can measure in real time what's working, what's not working, and roll that into iterations of the policy that will make it more effective over time. But I think this question of how does one find the other in terms of interested investors, communities that have needs, and individual entrepreneurs and small business owners who want to be noticed, that's one of the key innovations that's going to happen as the market stands up. So it's really wide open space. I know a lot of folks in the philanthropic community are thinking about how they can help facilitate that. It's something that we're thinking about at our organization. So I think there's going to be a number of different ways to get at that, but ultimately state and local leadership is going to be the key anchor for how to raise the visibility for everybody.
Right. And I actually want to tell a quick story. Recently, so Secretary of the Treasury, Stephen Mnuchin, was talking about essentially the opportunity zones. And there was a very affluent investor that said, hey, can I just buy a business and move it into a low and moderate income neighborhood and get the tax credit? And the Secretary just stamped on him and said, no, that's not adding value, and actually really shared the vision and mission of this. So I can honestly say that it was really enlightening for the group to hear that there was an alignment of what the social return needed to be. And so this finding the right opportunities is going to be a key thing. But as Kim said, there's also existing stakeholders that have been on the ground that might be a good resource.
So I would just say that those existing investors in community today are absolutely essential to making this program work, because John and I were talking earlier today that opportunity zones really need to be one piece of a community investment strategy that leverages off of other new market investment, SBA loan guarantees, LIHTC. And it is kind of the knitting together of all those pieces that our community financial institutions, development finance, know how to do so well. Mm-hmm. You know, I gave the example of John and I were talking about blight removal. Well, you know, blight removal is a terrific thing, but many lenders who have been in those communities also recognize that, you know, that open space then needs to be remediated. You need to think about the school down the street. And so I do think that this program, one, it's a really fabulous example of looking differently at our toolkit, and I really commend that. But we really need to leverage the experience of our community investors and harness the lessons that they've really been learning for the last 25 and 30 years.
100 years.
I would like to take a whack at the question about
Small
the
business.
capacity of small businesses, because CDFIs, when we certify CDFIs, I mentioned a couple of criteria. You have to have a community development mission, you have to invest 60% of your assets in low and moderate income communities or target markets. The other thing we require is that you offer development services alongside your financing products and services. And that's really the key to what makes the difference. And if there's a need for subsidy in the system, that's where it comes in that, you know, the hand-holding that CDFIs do, any CDFI that's running a small business shop, and their customers will tell you that in a lot of cases, that's even more important than the capital that they receive. And sometimes CDFIs will turn them down the first time or the second time and work with them until they're ready to actually borrow money. And so that's a dimension of CDFIs that I think makes them successful. You look at their track record in terms of loss rates, they are right there, even though they're investing in high poverty areas and they're investing in entrepreneurs who have been turned down by other banks, because usually they don't start with CDFIs, they'll start with their local bank. Their success rates are just as high or sometimes even better.
Yeah, and I'm sorry.
I'll just add that the way I saw it was 3 components for business success. And one is, I think you just aptly put up the point about, you know, if you've got to know how to run your business. You have to know, you know, just have the technical knowledge of how to run a business. And so we at the SBA provide, and I'm not there anymore, but provide small business development centers across the country that are there, supported by the federal government, just to provide technical assistance about how to write your business plan, how to get certified, how to go into global markets, how to hire, how to build. All of those kinds of skills are there for you, largely complementary through the Small Business Development Network. So one is the counseling, the 3 C's. The second, we always thought about contracting opportunities, or you might say access to markets. And so in that way, the federal government also does, you know, if you get certified as a small business under the program, there are small business, if you will, set-asides, where the federal government sets aside 23% of the contracting program, and the U.S. is the largest procurer in the world. So we're talking about billions upon billions of dollars that are set aside for small businesses so that you can do business with the federal government. And oftentimes we're looking at how do we grow our markets, and we forget the federal government is probably one of the largest markets in the world. And so that program is available. And then the third component, of course, is just this idea of the capital that we just described. And so at every level, depending on where you are, SBA and you can learn about these at the Small Business Development Centers. Clearly, there is a program if you're at the private equity stage. There is mezzanine financing. There are microloans. There are, you know, the guaranteed loans where your loan is guaranteed. You know, 2/3 of your loan is guaranteed, and so when you get that kind of loan, you know that, you know, a bank is more apt to say yes. And so I would encourage you to look at those kinds of resources that are available in the community.
So does anyone want to touch the CRA question? For those that are interested, so historically speaking, when the Community Reinvestment Act was first envisioned, actually I think it was sponsored by a congressman from Wisconsin that wanted to put after the last Great Depression, financial institutions that were getting access to resources that were provided by the federal government, whether it was the overnight rate at the Fed or FDIC insurance, they are getting benefits from the federal government. And in exchange for those benefits, they have a responsibility back to the federal government's core constituency, which are the people. And so essentially, the law requires that based off of the access to the benefits from the federal government, you have certain responsibilities, and you are tested on 3 things. Essentially, based off of where your location is, how much lending you are doing, how much investing you are providing, and how much services you are providing based off of that area. So if you're receiving deposits from a certain area, that area should get some version of this. And there's essentially certain credit that is provided to those institutions in a way that then that credit becomes quite powerful when regulators look at whether or not you should merge or whether or not you should get access to opening a new branch. And so that was the premise behind it. And over the years, 41 years to be exact, it has changed quite a bit. There is quite a bit of subjective view versus objective view. I think the administration is now looking at a couple of different fixes. The OCC and Treasury are trying to provide a little bit of guidance. There's question marks of what's going to be the case, either in the form of whether or not the assessment area is a valid point, and I think there's arguments for and against that. I'll leave that at there. And there's also questions of essentially what could qualify as essentially from a financial institution, how they should be subject to these things. If you're a fintech player and you don't have a footprint, what is your assessment area? So there's a lot of questions out there, and I think there's more required in both understanding the unintended consequences of a fast move on policy, but also there is absolutely an alignment across the board that it just needs to be done better.
Yeah, I mean, I'll say two things about it. The first thing is that Treasury did put out a memorandum to the agencies, and it was notable to me that that memorandum was hailed by the full spectrum. So the NCRC, which is the strong advocates for CRA, commended it, as did the American Bankers Association. So
which is unheard of to have those two organizations agree on something.
yeah, so there was that. And then secondly, I would just say that that the regulators are going to put out what's called an advanced notice of proposed rulemaking, ANPR, and that's a public process. So these questions are going to go out to the public. So there will be a public square, if you will, with respect to the agencies, the regulators, gathering information on what the public feels should happen. So.
And I did want to just add a few comments to your question about the need for banks to be actually in the community and the importance of that. When I was CEO of Mechanics and Farmers, we created a youth advisory council with high school and college students. And I was amazed, just given obviously technological advances and the amount of telephone banking and online banking that they enjoy, that the one thing that was critical to them was that when they had a problem, they had some place to go to actually sit down and have a conversation. And so I do think place-based access to capital and advice is critical. And so I would hope that we would continue to foster having a place for people to go where they can have a conversation about what they need for their capital requirements.
I love that you said that, Kim, because as a banker, I can't tell you how many women came in and said that they were coming to us because their other bank had asked them to put up a personal guarantee on a business loan they were taking out. And I'd say, tell me about the business. And you could see that there was enough collateral there to take out the loan. I'd say, why are they asking you to put up your home? So this question of being really informed and understanding how to manage capital and leveraging capital, I think is fundamental, particularly for those who haven't had the experience, so that we know when we've been had and when we think we have leverage. I just had a friend who said, I said, go back in and say no. And so he went back in and he said, no, I'm not going to put my home up. I think the business has enough cash flow, it has enough collateral, the business itself, I'm not putting up my home. And then the banker said, okay, fine, we'll do it. But like he had to, he needed some advice. And so I think it is important for us to make sure that we have a trusted financial advisor to lead us through the way if we're not comfortable
That's
with
an
those.
important point. And one of the things that came out in our study, when you look at essentially for any business, when it starts, where's the first line of capital? It's usually friends and family. That's across the board, across the nation. But when you double click within minority communities, the second line of capital is actually a credit card, while for most non-minorities, the second line is bank capital. And those are unbelievable incentives, disincentives that really impact the success of a small business being able to survive, continue to grow jobs, and so forth. And in essence, your place-based question, I'll ask a question of the panelists. We have about 5 minutes, so we'll use this as kind of the linchpin. There is essentially, if we 30 seconds. If we don't get this right in terms of having capital move into disadvantaged communities, what's going to happen to the American dream? I'm going to ask you folks to answer that from the glass half empty. And since we're the Milken Institute, we'd like to end on the upside. I'll ask this group to answer. What happens when we get it right?
So I'm going to just have to say that I don't think we can afford to not get it right. So failure to me is not an option. I think the cost would be the escalation of many of the societal problems that we're facing today. And so we have to get it right.
We did an analysis of the municipal bond rating of a place in the South. And that place is affected today by a significant amount of dependent population and unemployment. And if you extrapolate the level, the rising level of income inequality in our country, it's a risk to all of us. And so I agree with Kim that we can't get it wrong, and not only because there are dire consequences for the people that don't have access to capital, that can't provide for their families, but because it will affect all of our quality of life. And I think that, you know, as our society has changed, as we know our neighbors less, we think that that's somebody else's problem. But I believe that it really is all of our problems, and we need to own it with good policy, good access to capital, and the trusted advisor that comes, you know, from a local community investment organization who really understands the needs of place.
Thank you.
Well, you did say it's my birthday, and I have to say I've been around long enough to know that we know what the solutions are. We just have to have the will to do them. And I think, you know, I have a fantastic job because every day I get to tune into the stories of people who beat the odds, and it's inspiring. And you know, the American dream is alive in the hearts and souls of a lot of very hardworking people who are doing great things.
Thank you. What happens if we get it right?
Then I think we're all richer and more prosperous as a country. The exciting part about this is, for as great as our country is now, we're leaving a lot of our best brains, a lot of our best talents, a lot of the best entrepreneurs on the sidelines. And so if you think about a world in which we put that human capital to better use, and that we give them a chance to be a part of that broader prosperity, it really is to everybody's benefit. And that's a much healthier market. It's a much healthier economy. If you just look at jobs created in this country since the year 2000, there's been about 6.5 million net new jobs as of 2015. So let's use that as a cutoff. If that bottom quintile I talked about earlier, if it had just been stagnant, we would have had 9 million net new jobs created as a country. So that's a big difference in recovery. That's a big difference in overall demand and prosperity for companies trying to buy and sell, and for all of us. So that speaks to the potential here if we just get it, even at the worst off level, if we get it back to a baseline, not even doing phenomenally well, just a baseline. That's tremendous potential that we unlock for our country.
Oh, that's great. I would just say that having represented the U.S. around the world, and feeling the level of dependency, that's not the right word, feeling the, so many countries look to the United States for leadership and to create democracies and to deepen their middle classes, the role that we play around the world. I remember being in Estonia and how worried they were that Russia would come back in. I remember being in Cuba and trying to deepen entrepreneurship in that country. I remember being in Morocco, in Colombia, for example, where you know, a person I was engaging there, 45 years old, said he had never lived in his country in a day of peace because of the FARC civil war that was taking place there. And so people look to the U.S., and so getting it right means that we will continue to be a preeminent peacekeeper in the world. It's not our sole responsibility, but it's a major responsibility, I think, that we bear if we want to make sure that our values, when we export, we're not exporting just goods and services, we're exporting the U.S. and American values of the power of the middle class, of entrepreneurship, of starting in one place, at one station in life and moving up to the top. And that has been so possible. We've replicated success over and over in this country. And you want to see that taking place around the world so that we can continue. The interconnectedness is undeniable. And so when we get it right, we will continue to be that power. And we can't take it for granted. And meeting after meeting, as we were stepping out, the Chinese were right behind us, try to cut their deals, and the Russians behind them. And so we can't take our leadership for granted. We must continue to be the moral leaders of ethical, middle-class standards so that we can make sure that our children will live in a world that we all envision for them. Thank you.
Thank you, Maria. And I would have to say, we couldn't have ended more patriotic if I hadn't asked all of you to stand up and do the Pledge of Allegiance. Which, short of that, let me just say, enjoy the rest of the global conference, and thank you for joining.